Welcome to Factful Finance, where we help you navigate the complex world of personal finance with clarity and insight. Did you know that peer-to-peer lending has grown exponentially in recent years, offering an alternative way to invest and borrow? But as tempting as it may sound, this growing industry brings with it some tricky tax implications that could catch you off guard. Let's dive in and explore the tax rules for peer-to-peer lending so you can avoid costly mistakes. Before we get started, a quick reminder. This content is for educational purposes only. For personalized advice, always consult a professional. Peer-to-peer lending, or P2P lending, has gained traction as an accessible investment opportunity. In simple terms, it allows individuals to lend money to others through online platforms, bypassing traditional financial institutions. The attraction? Higher potential returns than typical savings accounts or bonds. But, like all investments, it comes with tax obligations. Let's break those down to ensure you're not surprised when tax season comes around. The first thing to know is that any income you earn from P2P lending, whether through interest or fees, is taxable. Just like earning interest from a bank savings account, the interest you receive from loans made through P2P platforms must be reported to the IRS. Here's how it works. Interest income. The money you earn from lending to borrowers is classified as interest income. This means it will be taxed at your ordinary income tax rate, which can be as high as 37%, depending on your tax bracket. So while the returns can be appealing, the tax hit might surprise you if you don't plan accordingly. Reporting requirements. Most P2P platforms will issue a 1099 INT form at the end of the year, which reports the interest income you earned. If you've earned $10 or more in interest from a platform, you should expect this form. Don't forget, this income must be included on your tax return, even if you don't receive a 1099 INT. It's always a good idea to keep detailed records of all transactions on the platform to ensure everything is accounted for accurately. Now, let's talk about loan defaults and bad debt. If a borrower defaults on a loan, you might be able to deduct the loss from your taxable income, but only if the loan is considered a bad debt. This typically applies if you've made a loan to an individual and it's not expected to be repaid. To claim a bad debt deduction, you need to show that you've made efforts to recover the money and that the debt is truly uncollectible. But here's the catch. The IRS has specific rules for these situations, and it's important to work with a tax professional to make sure you're meeting all the requirements. There's also the possibility of capital gains taxes. In some cases, you might sell your loans on secondary markets or receive a lump sum payment. In those situations, the profits you make could be subject to capital gains tax. The rate depends on how long you held the loan, whether short-term or long-term, and your income level. Tax deductions and strategies. If you're actively participating in P2P lending and treating it like a business, you might be able to deduct certain expenses such as platform fees, interest paid on borrowed funds, and possibly even travel expenses related to managing your lending activity. Keep in mind that this is a gray area, and it's essential to consult a tax expert to determine what applies to your situation. One more thing to consider is state taxes. While federal tax laws govern much of the tax rules around P2P lending, state tax laws may vary. Some states have specific guidelines about how P2P income is taxed. Make sure you understand your state's regulations to avoid any unwanted surprises at the end of the year. To help navigate these complex tax rules, consider using financial tracking tools or consulting a tax professional who can guide you through the process. If you're new to P2P lending, you might also want to start small and get familiar with how taxes impact your returns before diving in deeper. Let's wrap up with a practical example. Let's say Alex made $2,000 in interest from P2P lending in 1 year. He'll need to report that $2,000 as income, which could push him into a higher tax bracket, depending on his total income. If one of his borrowers defaults on a loan, Alex may be able to claim a portion of that as a bad debt, lowering his taxable income. He also keeps track of the platform fees, which could help reduce his taxable income even further. The key takeaway here? Peer-to-peer lending can be a great way to diversify your investment portfolio, but understanding the tax rules, is essential to avoiding surprises down the line. Now, what's the first step you'll take toward managing your P2P lending taxes? Let us know in the comments. Thanks for tuning in to Factful Finance. If you found this video helpful, why not click the subscribe button and hit the bell so you don't miss out on more strategies that could help optimize your finances. We think you'll find the next video on our channel both insightful and beneficial for your financial journey.